Hey, welcome back. So in this video, we're going to be talking about exactly why we trade, because it's really important to know why as much as when. So there really is only one reason to trade: to make money. We don't trade to have fun. We don't trade to be in. We don't trade because of FOMO. You should only trade when you have clear signs from our strategy that tell us that we know price is likely to move in our favor. We know exactly where we expect to take profit, and we know exactly when we'll exit, how to protect our capital from losses. Not every trade is going to be a winner. So it's really important that you understand, if whatever happens, if X happens, that you'll close the trade because it means that it's no longer working. And if a trade is not working, if it's not making you money, then why do you want to be in? So how do we know when to trade? Well, it comes back down to the laws of momentum, because we cannot move price all on our own, and we really only want to be getting in when price is in the right conditions for movement. So it's really important that we learn to flow with the momentum, that we trade alongside the big financial institutions, and that we profit from the waves that their price action creates. So as momentum traders, we like to measure these waves to identify the exact moments in time that price is past the point of no return, when it's just absolutely getting ready to move and provide us with a chance to lock in some big profits. So we call this the ignition point. So just like in a car, once you turn your ignition on, you put it in gear and it gets rolling, depending on the type of car you drive, you can get moving pretty fast. So there's just a moment in the markets before price starts to rally or decline, when the ignition is on, the car is in motion, and it's just getting ready to start rolling and it doesn't want to stop. So we only look to enter setups when the engine is on, already turning on, and the car is starting to roll. Once we see that the car is rolling, we want to get in for the ride. So it's also important, like I said in the momentum section, when we're talking about the laws of momentum, that expecting a stock that's not moving to give up big profits is no different than expecting a car to get you where you're going when you haven't even turned it on yet. So we really only want to be getting in trades when price is moving, and we want to get in, lock in those profits, and get out. And if price is not moving, then there's nothing really profitable happening, and we just want to stay out and wait for the time to get in. So when we think about the laws of supply and demand, we were talking about those in the last sections too. In trading, we think of an area on the chart, areas on the chart called support and resistance. Support is an area or a price level on the chart where buyers typically show up. This is an area of high demand in the chart, whereas resistance is an area of high supply. This is a price level or an area on the chart where sellers typically show up, or they have historically. So there's two types of support and resistance that we really need to be aware of. There's structured, which is historical support and resistance levels. This is an actual price that we did not beat previously. So price was rising, for example, and it stopped and started falling. So there's an actual number where it stopped rising, the highest number before it started to fall. And we call that number resistance. And on the other side, a historical level of support, when price is falling and it stops falling, starts going up, the lowest point on that chart, the price that is support. Price did not go below that number, and we found buyers at that number and changed direction. So we call these historical price levels. We also have dynamic support and resistance. These are support and resistance that follow trends, either trend lines, moving averages, Bollinger Bands. There's a number of different dynamic support and resistance that we're going to talk about, we're going to look at. But for most of our trading decisions, we're going to be focused on those historic price levels, the place where price actually stopped and then changed direction. What's that number? Okay. So when we're thinking about support and resistance, and we're thinking about continuations in price, I've just got a chart here of SPY. I've marked an area of resistance. Price did not move above this number, 358.75. Over here, price did not move below this number, 319.64. So we can say that this is an area of high demand and this is an area of high supply. So in between here, we're range bound, right? But then price starts to break out. And once price successfully starts moving higher, it tends to want to continue higher, as it did here. So this is our first law of motion. Price that is moving higher or moving lower tends to want to continue in that direction unless a strong enough opposing force comes along. So all of the strongest trending stocks in the market are guaranteed to have at least one thing in common. They all exhibit something we can easily measure, continuations of strong momentum. And we do this, when we do this, we really want to be stacking the odds, stacking the time frames in our favor, capturing that second law of motion, because we know that the faster price is moving in one direction, the more likely it's going to give up great profits, offer an excellent trading setup, a high probability trading setup with minimal risk. So when we're looking over here, we can see that price kind of fell, it rose, hit resistance, and then it closed. We have this candle that's actually closing above resistance, and then we trend higher. Profits were given up right through here. Anybody who got in on this breakout was able to capture this profit, right? Same can be said over here. Price stopped moving above this, or stopped moving at this high, this number, and on this side, price starts breaking out, and anybody who got in on that breakout was able to capture this momentum. Very big profits. Same thing can be said over here. Although I believe that this resistance came from over here somewhere, or I can't exactly see where I have the line, but price broke above the resistance marked in this chart. Once that happened, lots of profits to be gained, consolidated, breaking back above resistance, continuing higher. So whether price is moving up or down, we can easily identify the same ignition point before price goes on these great runs, either a great run up or a great run down, offering excellent profits to investors. So here's another example. Price found support. We were falling, stopped falling, but then once price started to close below support, big profits were given up on this stock. This is Apple again. Over here, price is falling, finds some support, breaking down through, big profits. On the other side, when we're retaking that support, we're breaking above resistance, price makes a nice move up. Break above, nice move up. I mean, this is $10 move on this one candle. So if you got in on that breakout, $10 is an excellent profit to get in on. So why do we trade? To make money. When do we trade? When something is actually happening. As momentum traders, we trade continuations of strong momentum, meaning we see price moving, we notice price breaking above or below a price it had previously not traveled beyond, and then we get in on the action because we expect price to continue in that direction. We don't guess, and until price closes beyond support and resistance, nothing new has happened. Price is range bound and not continuing. And if it's not moving any particular direction and it's range bound, then it's definitely more difficult to lock in profits. I mean, you could be trying to jump in at the support and resistance levels, but if you have strong momentum, then you're going to get stopped out of your trade. So really, we want to be getting in when something new is happening, something that we can, a wave that we can ride into big profits. So a few key considerations are we only trade to make money. We don't trade to be trading or to be in. This is tantamount to gambling. So we only want to be entering trades when we have clear signs that something is happening. it's also important to note that price and what it is doing is all that matters to your trading plan. If price is in a range bound area, it's not breaking above support or below support or above resistance, and it's just going up and down, then we really don't have direction and there's no profitable trade to be taken. Okay? The market is always right. It doesn't matter whether you think price should rise, fall, where you expect it to go in the next month, week, day, or whatever. The market is always right. Price is where it is. It's going to go where it's going to go. All we can do is ride the wave, enter when we get clear signs that something is happening, take profit at our targets, and exit when price closes on the other side of our stock. Follow our trading plan. Now, FOMO is absolutely the number one killer of accounts. It's the number one reason most traders blow up their account. It's really important that you don't rush into or out of trades before you get signals it's actually time to make a trading decision. Sometimes price will go above resistance, go below support, and then go right back the other direction. We are looking for closes. We want to see that price can sustain itself beyond that level. It can actually hold above or below that level. And we determine this by the way the candles close. So until candles close, nothing has happened. And if you have FOMO, you feel like if you don't get in right now, you're going to miss it. Keep in mind, that's the number one killer of retail traders' trading accounts. I can't tell you how many times that those types of things will happen. You will get faked into a trade because you did not wait, or you'll get faked out of a trade because you did not wait. Perhaps price flirts with your stop loss, but at the end of the candle, it holds and then continues. But during the candle, price was looking like it might stop you out. And during that candle, if you exited your position and you took your small loss or you just closed down the winning trade before the candle closed, you might find the next few candles really punish you as price keeps going in your direction and you're no longer in the trade. So getting in and getting out of any trade should always be dictated by the way a candle closes. Don't rush in, don't rush out. The close of the candle is what matters. All right. So in the next section, we're going to be talking about why we trade options and a little bit more about how we trade options with our strategy. So I'll see you in that section.